So that is still an open issue. So if you transfer an undertaking to another undertaking and in exchange get shares in that other undertaking, if the difference is there between fair value and the cost of the undertaking which you transfer below, that can be subject to MAT book profits in that transfer entity. That is one question which is not addressed. Now, post Bharat, there are two more decisions which are on the same point. One decision is in the case of Delhi High Court in the case of shared infrastructure. In shared infrastructure, the differentiating factor which was brought out in Bharat was that in shared infrastructure they mentioned that I am transferring business A to another company for X consideration, say 100 rupees, and in discharge of that consideration, these shares are issued to company A. So there the High Court said that the slump sale definition is wide. So money's worth doesn't mean just cash. Money's worth is anything which is worth the money or worth value. And secondly, the slump sale definition starts with transfer or way of sale. So transfer takes the definition from 247, which talks about all kind of transfer, relinquishment, exchange, everything. So this is the slump sale. And because you mentioned the consideration, that clause, that is the consideration and discharge of that additional shares, will be part of the slump sale. That's the second variation. Third variation is another case law. In that particular case law, I will tell you the name of the case law. Third variation is in the case of virtual software, which is a Delhi ITAT judgment. There what happened was similar thing. Undertaking was transferred to another company. Company issued shares at face value to the company which is transferring the business. Now the contention of the assessee was that you taxing on the face value for the shares which are issued. But the revenue side had nothing to do with taxing on the fair value. So they took it as an exchange, and based on earlier judgments, in case of Wash and a lot of judgments on exchange, they took the market value of the shares and compared it to the cost as per some sale and sought to tax it. So there are three different variations on this term exchange. And the predominant way in which things are being structured, and if you look at the scheme recently, is that there could be practical difficulties. The company may not have the funds in the internal restructuring to actually do it for cash. So in a situation like that, in schemes it's mentioned that my money's worth consideration is X, and in discharge of that consideration, I am issuing these bonds. Preferably should be bonds, because at least you can say that's a payable. If it's equity shares, then the danger which is there in virtual software is there, because then they can say it's a fair market value of the shares which will be the consideration. So it's being actually structured in that manner, and just to get out of slump exchange and get into slump sale. And that's why this is the trend which we are seeing. But then again, this matter is still not closed. We'll have to see how it pans out at the Supreme Court level. So
the slump exchange between two group companies internal restructuring, and there is bonds which are issued against consideration. While capital gain there are judgments, but wouldn't there be a deemed dividend risk because I'm deferring consideration or giving a loan of sorts to pay that money back to me?
No, but then you're giving up the business also.
I'm giving up the business.
So it's not entailing the release of assets. So if you transfer the business from A to B, and in consideration of that you are getting these bonds, you are actually giving up something. So there is no distribution of assets which is happening from the subsidiary to you.
So these are two group companies, both have common shareholders. Business moves out from company A to company B, and non-convertible debentures are issued for 3 years. So effectively what I am doing is that I am getting consideration after 3 years for the business transfer. So can it not be deemed as
no, far-fetched. It's more in the situation of bonus debentures. There the individual issue is higher. Any other thoughts on this?
Suppose slum exchange is through court order or court scheme, then we can say that this is not an exchange, and we can move out of 247. That is one school of thought.
No, it doesn't work because court now is like court can't bless something which is not in the law. So income tax act will have its own local standard and the court rules will have its own local standard. So in fact, everything is now parallel. As I mentioned earlier, original director has to do income tax and ask him, do you see any issue in this? So really, it's up to the income tax department to judge on this. So it will not take you, so anything under the code scheme is not neutral. You have to comply with the tax code.
Because of IT it says,
Sorry?
stray infrastructure decision.
Correct. One more point here is, of course, the MAC issue is there. The second thing is, in the light of the accounting changes which are happening in India, we may land up in a happy situation, in the sense that in a situation where the holding company is subsidiary, and you are doing slump exchange in that subsidiary, right? As per India, in a situation where it's a group sort of a transaction, intergroup transaction, there really you don't recognize profit in the books. So with the blessing of auditor, if you can account it as something as cost of investment or reserves taken related to cap reserve under India, that should serve the purpose for MAT. Earlier you will take it P&L account. Only if it's blessed by auditor as some other treatment, then you could have got away with it. But now actually you have a leeway in group transactions, at least in some issues.
Okay.
Okay, so I will just, all of you are aware of section 79 of the Income Tax Act, which talks about if there is a change in 51% or more of voting power held by beneficial shareholders in that particular company, private company. In that situation, business losses or any other losses don't move, another depreciation will move, and you can carry forward for set off. So the biggest debate in this is, when you say this word, on the last day of the previous year, share of the company carrying not less than 51% of the voting power were beneficially held by persons who beneficially held shares of the company carrying not less than 51% of the voting power on the last day of the year in which loss was. So what is this beneficially held? By beneficially held, do we mean the registered shareholder? Or do we mean the person above the registered shareholder, above the shareholder company which is registered? So there are judgments both ways. So there are two schools of thoughts. One school of thought, like in the case of Hemco Power, which I mentioned here, high tax judgment. It was held that if ultimately the beneficiary is the same, transfer of two company shares really doesn't matter because ultimately the beneficiary shareholder is the same. So really 79 losses should move, should not apply. There are other schools of thought which say that registered shareholder is the key. So if there is a company A, company B, and company C, and C has losses, and the transfer of shares happens at company B level, A transfers shares of B to some other party. In that situation, does 79 apply? Answer is no, because the registered shareholder is B. It's not happening at the C level. So the preponderant view which is coming out in 79 is registered shareholder scores over beneficial shareholder. Now there is one unique situation where this will give a very absurd result. So there is a trustee company which holds shares of a company which is in losses in trust for some beneficiaries. And you change the trustee company. Now registered owner is trustee. So each situation has to be applied to facts and circumstances. There could be debates on it that, okay, just because my trustee has changed and it's my choice as a beneficiary to change the trustee whenever I want as a trustee, will that mean that 79 will not get losses moving forward? So the most importantly here is, and if you see all cases, every 222E is worded in a similar manner like this: voting power, beneficiary, and there the view always has been that in the case of Naik color company, it's been held that you take a registered owner, and there's no need to over intellectualize it and interpret it beyond it, because you should simply interpret the way the law is in the particular section. So the better view seems to be change in registered shareholders triggers 79, except in situation like I mentioned trustee. How do you do what? Okay, there's another interesting. So where there is a company which is a shareholder in another company and the investing company is in losses, and when you merge that shareholder company into that particular company, does it trigger 79? So in one of the case laws, it's mentioned that it's a death of a shareholder, and it's a Delhi idea in the case of select holidays, where it's mentioned that when one company gets merged into another company, it's like the death of that shareholder company in that company, and so 79 should not apply. By the way, that's an exemption in the 79 clause which says that if there is a death of a shareholder and there is a change happening for that, it should not apply. Third part is, as you all know, 72A, in a situation where a company owns an industrial undertaking, and industrial undertaking has been defined as engaged in the business of, you're engaged in the business of manufacturing, software manufacturer, all those capital heavy businesses. In that particular situation, when you merge that company to another company, the losses move in the scheme of amalgamation from the merging entity to the merged entity. And not only that, you get period of 8 years, fresh fees for those losses. So the question is whether 72A will override 79, because there could be a situation where in a third party merger, there could be change in shareholding. So industrial undertaking company may be held by other set of shareholders, and the merged entity, the company which is merged, is held by other set of shareholders. So in that particular situation, what overrides what? So the view there is 72A overrides 79, because 72A starts with notwithstanding anything contained in the Act, and 79 is restricted only to the chapter in which it is contained. So that's the view. 72A, the losses ought to move and you get a fresh lease of 8 years. Now this particular case is very, very interesting. This particular company was into two businesses. One business was manufacturing business, second business was power business. Now there were losses in the power business, but the business had not taken off. So although they had got the licenses, they had done all the preparatory work around the business, they had set up the plant, but it had just not commenced the production. So in a situation where that particular company merges into another company, with the losses pertaining to the power business, which has been set up but not commenced business, move in the merged entity. That was the debate. And what was ruled in the case of KBD, sugars and distilleries, the Karnataka High Court decision, is that the words which are engaged. So it's not necessarily a commenced business. So if you are engaged in the business of power, and engaged is ready, it's like set up, it's ready to commence, it may not have commenced. So we had licenses in place, we had everything in place, but it's not yet able to commence for some period of 3 years. That doesn't take away the benefit. You should get the benefit of the losses. Any questions? Okay. There's a recent AR ruling in the case of merger of two foreign companies. So the facts was that there was a parent company based outside India, which is 100% subsidiary in foreign company 2, and also holds 15% in the foreign company 1. And it holds 100% in the Indian company, which had recently sold business to a branch which is under foreign company 1. So that's the structure. And then the foreign company 1 merges into foreign company 2. In that particular situation, the branch which is under foreign company 1, which is a merging foreign company, moves on to foreign company 2. Now, if you know, there are some exemptions given under foreign restructuring under section 47. And one of the exemptions is when two foreign companies merge, if that particular transaction is tax neutral in the country where it is happening, and also if shareholders become shareholders in the merged entity to the extent of 25%, it's a tax exempt transaction, but it is only exempt in the situation when Indian shares are transferred. Shares of an Indian company are transferred. Now, in this particular situation, if you see, what was being transferred was the branch under foreign company 1 in the merger. And the question before AR was, is it really a tax neutral transaction under 47(6)? Because what is being transferred is not Indian shares. is transferred to the business which is housed in the Indian branch. And it's a very refreshing ruling. It was ruled that applying the non-discrimination article of the India treaty, you can't put the foreign company in a more difficult situation compared to the Indian company. If the Indian companies were merging, the branch would have moved and they would have been a tax-exempt merger. So you cannot put him in a disadvantageous position just because of foreign company. And non-discrimination article 25 of the India treaty says exactly that. In applying that article, you ought to get the exemption under the treaty, actually. So this was exempt. Although it didn't strictly comply with the 47.6. Then, as all of you must be aware, tax treaties are undergoing change. The entire controversy around India Mortgage Treaty, capital gains exemption, thankfully the government has finally brought clarity on that front. And what it states that all investments in shares which are prior to March 31st, 2017, if you transfer them post that date, you still get the exemption under the treaty because it gets grandfathered under the treaty. Anything between April 1, 2017 and March 31, 2019, if you transfer those shares, there will be a concessional rate of tax which is 50% of what is applicable in India. In long term it's 10, so 50% of 10 is 5, and short term 30, so 50% of that. Now, anything beyond that will be taxed at normal rates. So it's become very clear. But there are still some controversies. So the controversy and questions which are unanswered are, in a situation where now if you see all private equity have compulsory convertible instruments, because under FEMA you can't do optionally convertible, you have to have compulsory convertible. So there is CCD, CCPS, which is compulsory convertible debenture or compulsory convertible preference share. What happens if you transfer those particular instruments post April 1, 2017? Should you get the exemption or no? Based on a reading, you should, because this applies only to prior to March 31st shares, investment shares, not to other instruments. Debate doesn't end there. If post April 1, 2017, those particular shares get converted into, say, equity shares. So compulsory convertible preference shares get converted into equity shares. Compulsory convertible debentures get converted into equity shares. In that particular situation, do you get grandfathering of whatever you had as CCPS or CCDs? Although secret circular seems to say that okay, under income tax law you will get that grandfathering. But really under treaty, that is not coming out anywhere clearly. So unless the protocol gives further clarity, you really don't know what will happen. Again, in a merger situation, you merge today, and there are merger shareholders. They get shares, say post April 1, 2017. What happens to those shares? Does the period of holding get grandfathered? Under the merger tax laws, obviously it has to be grandfathered, but under the treaty there is no clarity. So similar issues are there. Even in Singapore, they have amended a treaty just in line of Mauritius. As you all aware, Singapore was linked to Mauritius, so they have also amended. But the same issues persist. In Cyprus, they have taken them out of that blacklisted sort of a country and amended a treaty to say that your capital gains will be taxable going forward. Anything before April 1, 2017 will be grandfathered, but post that will be taxed. So all these changes that are happening are in line with this worldwide endeavor to have tax transparency, tax governance. No country should be shortchanged. So it's an OECD endeavor, and it's called BEPS, which is base erosion profit shifting rules. And these rules are evolving. And the entire thing is around three pillars. One is coherence of corporate tax at international level, realignment of taxation and substance. Substance will be the key going forward. And also transparency, reporting requirements. India has already started country by country reporting, more to do with transparency, but it's already started. So all these will be the three pillars in which the global tax philosophy will evolve going forward. As you know, there have been infamous incidents of late on the tax front globally, say Google tax, which has happened, the Irish problem, Apple is not paying taxes, Starbucks is not paying taxes. So the countries have come together to see how they can best align each individual interest and come up with a common code to see that we have a fair system globally. So some important action points are the entire world is evolving. Just before the session, I was just speaking to some people on digital, how digitized we have become. Facebook of the world, e-commerce transactions, what are happening, security breaches which are happening. So the challenges are different now. It's not a brick and mortar type of a situation. It's a digital economy. So how do you address the challenges? Your website will be somewhere overseas, server will be somewhere overseas. There is no P in India. But if I am as a customer accessing the website and taking the services or goods, so how do you address those challenges? There is a source which is happening. India is a big source of income for various countries, for various companies globally. So how do you address those challenges? So one step we have taken is equalization levy, as you all know last budget. If you take any online ad services, then you have to report 6% on whatever you pay. Irrespective of whether or not the ad company has a presence in India or not. So this is just one step, and we'll see far more steps on this front going forward. Neutralizing the effects of hybrid mismatch. So very often there are some countries, like especially Luxembourg, they have something called hybrid instrument structures, where if a Luxembourg company puts, say, convertible into another company, for the other company it becomes a debt, and you can claim interest on that particular instrument. And for Luxembourg it is an equity, and they have participation exemption rules. So both ways you are taking the benefit. So all that is going to be planned down. Similarly, you may be a UK headquartered company, but your base of effective management is in Ireland. In Euro rules, it is treated as Irish company resident, and you can take the benefits of that. So similarly, all this is going to be actually addressed, hopefully in the BEPS plan. Strengthen CFC rules. Now India is going outbound, so India has a lot of overseas companies in their group. So when you structure those overseas companies, typically you are holding companies which actually hold these investments all across the world. So what kind of substance should be there in that holding company? Otherwise it's just a passive company. And whatever income which comes and folds up into the holding company under the CFC law will be taxed in the Indian company's hands. So that would be something which we may see going forward. Limit-based erosion. India doesn't have thin cap rules, so we can leverage the way we want debt equity. Globally, the phenomenon is that there is some prescribed debt equity ratio, earnings to rules, which we will see light of the day going forward. Counter harmful tax practices. Again, dovetailing to this, we are